I'm still a big fan of Bitcoin because I think it is, digital gold. But what we've seen in the last, really in 2025, is the financial services industry and crypto are converging. And it really started with stablecoins, which is the chat GPT of crypto, right? Because it's viral adoption by consumers, businesses, banks, and now even Visa. Underneath the stablecoin industry is Ethereum. That is really like the backbone and architecture of stablecoins. So it's important to create a project that essentially accumulates Ethereum to essentially protect and have some influence.
Tom Lee has previously made headlines for bold predictions. From Tesla to Bitcoin, his forecasts have generated both controversy and confidence. But now, he's taking on a new role as chairman of BitMine Immersion Technologies. Investors are wondering, does his involvement make this the next significant crypto infrastructure opportunity, or just another speculative gamble? To celebrate reaching 5,000 subscribers, I've created a free guide on spotting breakout stocks. You can grab your copy from the description below. If you enjoy this kind of content, don't forget to like, share, and subscribe. It helps us reach more investors like you. Quick reminder, this video is not financial advice. Investing in stocks is risky. Always do your research before making any decision. All right, Tom Lee isn't just another market commentator. He's a figure whose reputation depends on high-conviction calls. His chairmanship at BitMine could both boost credibility and attract criticism. On one hand, his name draws institutional interest. Investors often look for leadership signals, especially when that leader has a history of shaping narratives around growth assets. On the other hand, leadership alone doesn't ensure execution. Markets will evaluate not only Tom Lee's reputation, but also whether the company can produce results that live up to the hype. Adding another layer to the intrigue is Ark Invest's $182 million stake in BitMine. When Cathie Wood invests, people take notice. Looking at her notable involvement, Tesla. Once dismissed as a bubble, it became Ark's flagship. Wood's bold $4,000 price target in 2018 drew attention. Tesla experienced a dramatic rise, confirming her confidence at least for a while. Bitcoin. Her $1 million forecast for Bitcoin solidified Ark's reputation as a visionary, although skeptics claim it's still a moonshot. Ark ETF. The flagship fund surged nearly 150% in 2020, but then plummeted more sharply than most of its peers by 2022, earning it the nickname of a wealth destroyer from some analysts. So the question becomes, is Ark's entry into BitMine another Tesla-like breakout, or will it mirror the boom-and-bust volatility that has burned many retail investors before? So, what exactly is BitMine? It's simple: immersion cooling for crypto mining. Think of it as submerging mining rigs into a special cooling fluid to prevent overheating and reduce energy waste. Besides mining, BitMine positions itself as a guardian of Ethereum-related strategies, aiming to profit not just from hardware, but from crypto's broader financial ecosystem. The company is branding itself as part of the picks and shovels strategy, selling the infrastructure that keeps the crypto economy running, rather than betting solely on coin prices. Last week, BitMine made headlines by adding $1.7 billion worth of Ethereum, over 373,000 ETH, to its treasury, boosting its total holdings to $6.6 billion. That's more than 1% of all Ethereum in existence, making BitMine the second-largest crypto treasury on record. Tom Lee himself called it lightning-speed purchases, saying the company is pursuing the alchemy of 5%, a strategy to secure a dominant share of ETH's supply. And they're not slowing down. BitMine even increased a $20 billion stock offering to buy more ETH, with Lee calling Ethereum one of the biggest macro trades over the next 10 to 15 years, thanks to the Genius Act and the expected surge in stablecoins. For context, Ethereum ETFs and treasury firms now control over 8% of the total supply. If Ethereum continues to gain institutional traction, BitMine could benefit disproportionately as a leveraged infrastructure bet. Strategic investors like Peter Thiel add legitimacy, hinting that insiders see a long runway. Partnerships or adoption of its immersion cooling technology could expand revenue sources beyond crypto, possibly into data centers or AI computing, a story that Wall Street favors. But here's what investors must not ignore. Profitability gap. Like many high-growth investments, BitMine is not consistently profitable. Scaling costs remain high, crypto cyclicality, Its fortunes are closely linked to Ethereum. Any decline in crypto prices could quickly impact revenues. Speculative valuation. With recent hype-driven gains, the stock already trades as if success is guaranteed, a risky situation if expectations aren't met. Execution risk. Bold strategies are worthless if management can't execute, and history is filled with ambitious blockchain projects that fizzled out. On the chart, BMNR has made a remarkable comeback. Not long ago, it was a low-volume penny stock. Today, it's a momentum favorite, fueled by institutional interest and massive crypto inflows. Following Tom Lee's appointment as chairman, the stock price surged over 500% to a high of $120, but has since dropped to below $50. There is a support zone around $32 to $33, where heavy buying consistently cushions pullbacks. For tactical investors, this zone is the line in the sand. Resistance zone, between $43 to $48, the ceiling has been tested multiple times. A decisive break above this level could open the way for the next move higher toward $56 to $63, where previous highs remain. Momentum indicators, neutral to bullish. RSI has cooled from overbought levels, suggesting potential for further gains if volume picks up again. Volatility factor, BMNR's beta stays above 1.4, emphasizing that this is not a stock for the faint of heart. BitMine Immersion is a story stock, combining visionary leadership, a crypto infrastructure wager, and speculative risk. With Tom Lee as chairman and Cathie Wood's Ark investing heavily, the story has plenty of star power. But investors must ask, is this another Tesla moment in the making, or just the next name to ride the hype cycle before reality sets in? That's the debate. And as always, the market, not the headlines, will decide. So, what's your take on this tech stock? Moving to two AI stocks redefining their industry. Nebius Group, ticker NBIS, the AI cloud challenger with breakout potential. When it comes to artificial intelligence, Wall Street's attention has been glued to NVIDIA, Palantir, and the household AI names. But quietly, Nebius Group has stepped into the conversation not as a flashy model builder, but as the infrastructure backbone powering AI workloads across Europe and beyond. Once considered just a Yandex spin-off, Nebius has transformed into a GPU-first cloud platform. In simple terms, it provides high-powered computing essential for training large AI models to companies that can't afford to build their own massive clusters. Think of Nebius as the utility company for AI, supplying the electricity that keeps data flowing. The narrative began with bank-breaking validation. In late 2024, Nebius raised $700 million in a private placement led by NVIDIA and Excel, raising investor confidence and unlocking a pivot toward hyperscale GPU cluster expansion. Jumping ahead to Q2, 2025 revenue surged 625% year-over-year to $105 million, sparking a bullish rally in the stock, more than 18%, and new guidance. $900 million to $1.1 billion in ARR by year-end. Analysts from Goldman Sachs and D.A. Davidson quickly raised their ratings. Wedbush's influential AI 30 list now includes Nebius, a nod from longtime tech watcher Dan Ives. That places Nebius among elite companies alongside CrowdStrike and Roblox, alongside giants shaping the AI future. What makes Nebius distinctive? AI-first infrastructure. Nebius operates GPU-heavy clusters designed for both training and inference, an alternative to traditional Tier 1 cloud giants. Its platform includes managed Kubernetes, tensor-aware stacks, and InfiniBand-backed GPUs. Global sovereign design. With roots in Yandex's fragmented international tech, Nebius blends European regulatory compliance with AI agility, aiming for national AI initiatives and enterprise deployment. A combination of private capital and strategic partners provides Nebius with runway over $1 billion in GPU infrastructure, 1 gigawatt of power sourcing, and expansion into key U.S. markets. Yet, Nebius remains unprofitable, with negative EPS rated low by analysts, EPS rating of 9 out of 100, reflecting both volatility and growing pains. Now let's take a closer look at the stock chart. This is where things get interesting. Nebius has been on a tear this year, up roughly 145% year-to-date. Notice how the stock recently tested. Support near the $65 to $67 zone, a level that's held firm multiple times. That creates a reliable floor for investors tracking entry points. On the upside, resistance sits near $75 to $78. A clean breakout above that range could unlock a run toward the $90 mark, based on measured move projections. Momentum indicators stay bullish, but not in the danger zone of euphoria, indicating there's still room to go before overheating. Nebius is emerging as a contrarian AI investment. While others buy NVIDIA chips or speculate on the next ChatGPT, Nebius is quietly developing the infrastructure on which those models operate. If management continues to deliver 600% growth and secures long-term enterprise contracts, today's price might look like a bargain in hindsight. But for risk-averse investors, the story isn't without volatility. This is a stock that could fluctuate as wildly as the technology it powers. Next stock is SoundHound AI, ticker SOON. Just before last week's earnings, we shifted our outlook from neutral to bullish, and that call has aged well. Since then, the stock has surged 49%, closing at $15.90 after a jaw-dropping 17.3% rally, even as the S&P 500 and NASDAQ pulled back. So, what's driving this breakout? The catalyst was a stellar Q2 earnings report. Revenue surged 217% year-over-year to $42.7 million, crushing Wall Street's $33 million estimate. Losses narrowed to just 0.03 cent per share, beating consensus by 40%. Management raised full-year guidance to as much as $178 million, with CEO Keyvan Mohajer calling it their strongest ever quarter. CFO Nitesh Sharan reaffirmed that the company is moving with speed to seize the boom in conversational AI. What SoundHound does. SoundHound's AI allows machines to understand natural conversational speech, not just rigid voice commands. That means a drive-through worker can be replaced by a digital assistant that takes orders naturally. Banks can handle routine queries without agents. Call centers can reduce wait times. Cars can become more interactive without needing touchscreens. It's a technology with sticky economics. Once deployed, companies keep paying ongoing fees, turning projects into recurring revenue streams. Clients like Chipotle and Casey's are already on board, and the pipeline keeps expanding. The risks investors can't ignore. But here's the other side of the coin. Valuation risk. At roughly 38x sales, SoundHound is priced for perfection. Profitability concerns. Despite narrowing losses, the company is still unprofitable. Volatility. The stock has seen 89 price swings of 5% or greater in the last year. That kind of volatility works both ways. For traders, it's a goldmine. For cautious investors, it's a heartburn-inducing roller coaster. This week, shares declined nearly 5% after an analyst downgrade cited overstretched valuations and an unclear path to profitability. The broader macro environment isn't helping either. The latest hotter-than-expected inflation data has pressured high-growth tech stocks, reminding investors that AI optimism doesn't eliminate Fed policy risks. For long-term believers in conversational AI, SoundHound deserves a spot on the watch list. For short-term traders, technical levels could offer tactical entry and exit points. Which of these three AI tech stocks are you watching closely? Or is the third stock the next Palantir? Let me know in the comments below. Remember this for information and educational purposes only. Investing involves risk. See you in the following video.